All right, all right. Happy Friday, everybody. Jeremiah Conger here with AnnuityAssociation.com. And you guessed it, we're back for another unbiased annuity review. Today we're discussing, I believe this is the first review of this particular insurance company. We're reviewing the Apex Advantage fixed indexed annuity offered by Ameritas Life Insurance Corporation. If you're not familiar with Ameritas, they've been around the block for quite a while. I believe they're over 100 years old. And looks like we're having an issue with our LinkedIn feed here. Give me 1 second here. What is going on? And anyhow, they're an A-rated company, and I'm excited to get into this review for you. So give me 1 second. I will share my screen, and we'll get the presentation up. If you're watching or tuning in for the first time, we specialize in unbiased annuity reviews. We take a look at each individual company and their product offerings to determine whether or not the products are good. We also take a look at the specific brochure for that product, delve into all of the terms and conditions. Later on in the review, we're going to take a look at the specific index crediting strategies and take them through a hypothetical back test to show the performance potential using the last 10, 15, and 20-year periods of data. And then last but not least, we'll take a look, if it has an income rider, which this product does, we'll take a look at how that income rider works and how it grows over time based on the specific parameters that we input for the hypothetical client, such as age, investment or premium amount, and the time of deferral, and whether or not it's single or joint life. So again, we're discussing the Ameritas Apex Advantage fixed indexed annuity. This is an independent review brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. Ameritas has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so let's go ahead and get the brochure pulled up here. Bear with me, and we'll get started. So again, discussing the Apex Advantage fixed indexed annuity brought to you by Ameritas Life Insurance Corporation. All right, so you've been working hard for your years to position yourself for your ideal retirement. It's important to choose a financial product that not only aligns with your goals, but also builds upon them. To help elevate the growth of your retirement funds, Apex Advantage Fixed Indexed Annuity from Ameritas Life Insurance Corp offers competitive guaranteed income potential so you can rest assured knowing you have a plan that can help meet your goals and keep you protected. So it's all about preparation. Apex Advantage is designed to help generate the income you need to accelerate your retirement. While income you can't outlive is vital, it's equally important to grow your money. Apex Advantage offers strong growth potential and valuable guarantees to help protect your funds from market downturns. So first, it starts with your premium amount. Your annuity's compound growth potential begins with your purchase amount, known as a premium. You can choose the premium payment that best helps you achieve your financial goals. Your initial premium amount can be as low as $25,000 or as high as $2 million. Apex Advantage is a modified single premium annuity. As such, it allows premium payments to be made only during the first policy year. During the first policy year, if you decide you'd like to contribute more money to your annuity, you may add premium payments of at least $5,000 and not to exceed $2 million in total premium. Contractual guarantees. One of the most important features of an annuity are the contractual guarantees. It is the main reason and purpose that people purchase these types of products for their retirement. The Apex Advantage provides a solid contractual guarantee to help shield your money from an economic downturn. If you decide to surrender your policy for any reason, your surrender value will never be less than the minimum guaranteed surrender value, which is equal to 87.5% of your premiums applied to the accumulation value, less any partial withdrawals and any surrender charges, plus any interest credited daily at the non-forfeiture interest rate shown on your policy schedule. And fixed indexed annuities offer accumulation potential. Your annuity's accumulation potential is driven by your selection of interest crediting options. Apex Advantage offers a diverse choice of options to help you achieve your financial goals. They offer a fixed account, and this is a fixed account that offers a competitive interest rate that is guaranteed for a 1-year period. So each year it will renew. Upon that renewal, you will receive communication from Ameritas of what the renewal rate will be. And that interest accrues daily and is credited monthly rather than at the end of the 1-year period, making the fixed account a valid option for a share of your money if you anticipate making periodic withdrawals. These guarantees obviously are based upon the claims paying ability of Ameritas Life Insurance Corporation. And if the fixed account isn't enough for you, they also offer various index options. These varieties of interest crediting options calculate interest based on the performance of a market index, such as the S&P 500. These are known as index options. Index options allow you to benefit from market gains without exposing your money to market declines. That's because interest credited is protected by a floor, so it will never be less than zero. As a result of this built-in protection, earnings within the index options are limited to a percentage of index increases, known as a participation rate. Although earnings are limited by a participation rate, there is no cap on the amount of interest that can be credited. So with any of these various index options that are available in the Ameritas Apex Advantage fixed indexed annuity, you're going to have what's called a participation rate. The participation rate is going to determine of the index's actual raw performance for that crediting period, how much do you as the contract holder participate in. So for example, if the index performance is 10% for that crediting term, and you have a 50% participation of that 10% raw performance for the index, you would be credited 5% after factoring in that 50% participation. Tax deferral. Fixed indexed annuities like Apex Advantage have a tax deferred status, which means you don't have to pay taxes on earnings until you make a withdrawal. This allows you to earn interest, on your premium, and on the amount you would otherwise have paid in taxes. This effect, called triple compounding, provides greater earnings potential over time and may help you offset inflation. Annuities held within qualified plans do not provide any additional tax benefits. So the next step is build. Now that you've prepared and are looking to continue building your dream retirement, Apex Advantage offers multiple flexible features that put you in control of the assets you've worked so hard to accumulate. It offers transfer flexibility. Throughout the life of your policy, you have the ability to adapt your earnings approach as you see fit to achieve your annuity growth goals. On any index date, you have the option to transfer your money into or out of any available interest crediting option, as long as the minimum transfer amount is met. If you choose not to change your allocations at the end of an index period, your money will renew into the same option for another index period. So one of the things that we offer here at Annuity Association when you become a client is what we call our Annuity Assurance Program. It's basically the red carpet experience or service that we roll out and provide to each of our clients free of charge. And that includes meeting with you annually to understand not only your index performance and the other various nuances of your statement and policy, but also to help you make an educated and informed decision on how you or if you should reallocate those index crediting options. So we'll provide all the analysis you need using our innovative software to determine the potential growth options available and whether or not we should move a portion of the funds to different index crediting options. And if you're looking for someone that's going to truly put your best interest first, and you want the ability to compare all of these annuities side by side in order to make a better annuity buying decision. That is what our mission is. If you'd like to work with us directly, you can visit our website at annuityassociation.com. Right there on the main page, you can do a number of things. The first thing you can do to really get a understanding of the value that we bring to the table with transparency and education, and that would be to request your free annuity report. On that page, you'll be asked a series of questions that will then allow us to curate and custom tailor a report based on your specific objectives, and we'll send that out free of charge. In addition, if you'd like to speak with us about comparing these annuities and making a better decision, you can schedule your free annuity discovery meeting right there on the main page. It'll link you to our calendar and put you on to one of our advisor calendars so that we can help understand you, what's important to you and your family, and ultimately help you do the comparisons you need in order to make a better decision. We'd love that opportunity to work with you. Next is access. Because withdrawals can reduce the amount you receive in future lifetime income, one way to build your annuity's accumulation and income potential is to allow it to grow until you're ready to start lifetime payments. If you need access to your annuity's value earlier, withdrawals, full surrender, or annuitization are allowed, but a penalty called a surrender charge will apply to any amount in excess of the penalty-free withdrawal amount. Because these products offer contractual guarantees of principal protection and potentially lifetime income if you have the income rider, the insurance companies essentially need to know that you're going to keep your money in these policies for an agreed amount of time. And they call that the surrender period. So in this case, this is a 10-year surrender period product. And right here, they're showing the schedule associated with that 10-year period. So surrender charges apply during your annuity's first 10 years if you choose to surrender the policy or take withdrawals that are greater than the penalty-free amount. The surrender charge is applied as a percentage of the amount withdrawn, and percentages vary by the policy year in which the withdrawal takes place. Now, if you are taking your lifetime income, that does not count towards the penalty-free amount, nor does it count towards any type of charge. You wouldn't be charged anything for taking that lifetime income within that first 10 years. The actual surrender charges may vary by state, so it's best to ask your insurance professional about the surrender charge schedule in your state. Here at Annuity Association, we service clients in all 50 states. So if you'd like to get more information, definitely go to our website and we'd be happy to see how we can help. Market value adjustments. These are either a positive or negative adjustment made to your withdrawal or surrender amount in response to market conditions. When a surrender charge is assessed, a market value adjustment will apply on the amount you access. And an MVA does not apply to penalty-free withdrawal amounts or after the surrender charge period ends. The market value adjustment is calculated based on a formula that tracks the interest rate environment since you purchased your annuity. The market value adjustment may increase or decrease the amount of the withdrawal or surrender. The actual market value adjustment amount may vary by state, and a market value adjustment may not be applicable in all states. It's best, again, to ask your specific insurance professional about any market value adjustments in your state. So essentially what this is insurance companies are some of the largest purchasers of bonds. And because bonds have a maturity period or a duration of time that they must be held in order to receive your money back without incurring any, cost associated, the insurance companies build those holding terms into these products. And what they do is they have these market value adjustments that can be applied in the event we don't hold up our end of the bargain when we purchase this type of product, and that is keeping the money in the account for the agreed amount of time, in this case, 10 years. So for example, if you purchased this product just 4 or 5 years ago in a lower interest rate environment than what we're in today, and then you decided to surrender the policy within that 10-year period, you would incur a market value adjustment that would, actually cost you money. You would be penalized because you bought the annuity in a low interest rate environment, and interest rates improved or got higher, became higher. Therefore, in order for the insurance company to sell out of their bond positions in order to give you your money back, they're going to have to sell those bonds at a loss or below par. And because of that, they will pass then that difference on to you in the form of a penalty known as a market value adjustment. Now, it also works the other way around. If you purchased this annuity today, as an example, being in a higher interest rate environment, and you decide to surrender 5 years from now when that interest rate environment is lower, then the insurance company would sell those bonds before maturity and sell them at a premium, meaning they're selling them above face value or par value, because the coupon on that bond is higher than what somebody could purchase in that current bond interest rate environment. So the bond has more value because it has a higher coupon or a higher yield that it will pay the owner. So you would actually be credited a positive market value adjustment, where instead of it being a charge to you, it would be a credit to you. So very cool. It works both ways. I've had plenty of people cash out and actually earn money from these market value adjustments. Penalty-free withdrawals. Each year after the first policy year, you may withdraw up to 10% of the accumulation value as of the beginning of the policy year without incurring a surrender charge or market value adjustment. You are free to use this liquidity feature to respond to life's unexpected events or for any reason. The waiver of surrender charge riders. Most annuities today offer some sort of waiver for these different reasons that you might need to surrender. So let's cover a few of those here. Should your health decline, waiver of surrender charge riders may allow you to withdraw part or all of your funds without incurring a surrender charge or market value adjustment. To qualify for a waiver, you must have been an owner continuously since the policy was purchased. If the annuity is owned by a trust or other legal entity, the annuitant is the qualifying person. Waiver of surrender charge riders may vary by state and may not be available in all states. So the first waiver of surrender charge rider is the confinement rider. If you become confined for at least 30 consecutive days to a qualified institution, surrender charges may be waived on withdrawals. To qualify for the waiver, you must not have been confined within 1 year prior to the policy date. So confined care would be another term for a long-term care institution, a long-term care facility. This is where you're unable to perform 2 out of the 6 activities of daily living. And if you're unable to perform those and you have an attending physician statement, you could then file for that confinement waiver, and all of your access to your money would be free of surrender charges or market value adjustments. Next is terminal illness. If, after the policy begins, you become diagnosed with a terminal illness that results in a life expectancy of 1 year or less, surrender charges may be waived on withdrawals. And then last but not least is the home health care. If you need home health care services from a licensed home health care service agency due to impairment in performing at least 2 out of 6 activities of daily living, these are bathing, continence, dressing, eating, toileting, and transferring, you may qualify for a waiver of surrender charges. You would be eligible for this waiver after the first policy anniversary if the conditions are met. You must not have been confined or required home health care services within 1 year prior to the policy date. And then last but not least, we have what's called annuitization. All annuities have the ability to be annuitized, which is the process known if you turn your full accumulation value into a lifetime income stream. So in exchange for giving up control over that principal account or accumulation value, in exchange for a lifetime income, that process is known as annuitization. Now, because this product does offer a guaranteed lifetime withdrawal benefit rider or income rider, the income rider is what prevents people from having to annuitize in order to get a guaranteed lifetime income stream. from an annuity. So in a product like this that you have elected to have the guaranteed lifetime income rider, you do not have to annuitize the principal account in order to get that lifetime income. And in addition, you maintain control over that principal account, and that principal account still has the ability to earn interest on a non-guaranteed basis according to how the index crediting strategies perform over time. Lastly, that index crediting strategy and that account value, those can become your death benefits in the event you pass away and there's still money left in that account. So any designated beneficiaries that you put in the contract, that money that's left would pass on to your beneficiaries. So that's all part of the lifetime income rider, which doesn't require you to annuitize and give up those features and those benefits to get the lifetime income. And they specify it here. Unlike payouts from a guaranteed lifetime withdrawal benefit rider or income rider, annuitization cancels all other features and benefits of your Apex Advantage policy and converts the policy's value into a series of payments. You may annuitize Apex Advantage at any time up to the maximum maturity date shown on your policy. However, if you select annuitization prior to the 5th policy year, surrender charges may apply. Apex Advantage offers several annuity options for disbursement of your annuity payments, including life income and installment payments. For installment options, you can choose to receive equal annual, semi-annual, quarterly, or monthly annuity payments over your lifetime or for the number of years selected from 5 to 30 years. Now, for full transparency, from all of the research that I've done on these types of products, less than 4% of all annuities out there are ever annuitized. So that a lot of that is attributed because of the income riders that are available today to still give people the ability to have a guaranteed lifetime income stream, but they don't have to give up control of the principal in order to get that lifetime income. Another full transparent thought here is, of the hundreds and hundreds of clients that we serve here at Annuity Association and the tens and hundreds of millions of dollars that we've helped people secure for lifetime income, we've never had one person annuitize their annuity. And that's because of the income riders again. So now that you've prepared for retirement and built upon your funds, it's time to finally enjoy all your hard work that you've put forth, free from worries about running out of money. When you purchase your Apex Advantage annuity, you have the option to add a guaranteed lifetime withdrawal benefit rider for an annual charge, providing a guaranteed stream of lifetime income. Your choices include the Future Now rider or the Future Now rider with booster, both of which are designed to provide early income so you can enjoy retirement sooner. Once you've elected a rider, it cannot be exchanged for the other. So there's two income rider products in this, options rather, in this product, the Future Now rider, the Future Now rider with booster. Let's talk about the Future Now rider first. Income payments can start as early as 30 days after the issue date, provided all covered persons are at least age 50. At this point, you can also elect to turn on either single or spousal payments. In addition, when you elect to begin taking income, you can choose one of two payout options, level or increasing. The level payout option provides fixed lifetime payments, allowing you to plan for payments that will not change. With the increasing payout option, payments start out lower than level payments, but can increase on each activity date to help you keep up with inflation or increased expenses. The Future Now rider is available for a 1.25% annual charge, which is all in line with the average management fees associated with today's 401k accounts, which is generally around 1.5%. One thing that a 401k cannot assure you of is a guaranteed lifetime income that you'll never outlive. And that's the difference between a lifetime income annuity and just keeping your monies in the markets via a 401k. The Future Now rider with booster. If you are concerned about healthcare costs derailing your retirement, the Future Now rider with booster can help to address those concerns. The Future Now rider with booster offers the same features as the Future Now rider. However, it also offers a booster benefit that doubles your income payments if you or your spouse, if you have elected spousal payments, become unable to perform at least 2 of 6 activities of daily living. Again, bathing, continence, dressing, eating, toileting, and transferring. The rider must be enforced for at least 2 years, and you must have activated income before the booster benefit can be triggered. The booster benefit continues until qualification is no longer met or the accumulation value reaches zero. Once the accumulation value has been exhausted, income payments will revert to the non-boosted standard amount. If qualification is no longer met, you will be unable to qualify again for the boosted amount. Each covered person may qualify for the booster benefit once during the life of the policy. The Future Now rider with booster is available for a 1.35% annual charge, so only 10 basis points more, and you get the features of that enhanced income benefit through the booster option. All right, so let's take a look here where these riders have 3 distinct phases. So we have the accumulation phase, which begins at policy issue, and this builds the value used to calculate your guaranteed income payments. The second phase is the withdrawal phase, which begins when income payments start. Receive your guaranteed income payments from your Apex Advantage accumulation value. And then the third is guaranteed phase, begins when your policy's value hits zero. Continue to receive guaranteed income payments for life. So the reason people purchase these types of annuities is simply because it mitigates the number one risk that we all face in retirement, and that is unfavorable sequence of returns risk in the markets. This tells us that in the event our policy's value goes to zero after taking income and depleting that account because we haven't earned enough interest to offset the income that's going out through the distribution, the contract of the income rider states that even if the account's value goes to zero, rest assured that lifetime income will continue to pay you and your spouse, if set up for joint, for the rest of your lives. As long as you both have a pulse, or one of you has a pulse for that matter, it'll continue to pay. Very, very powerful and provides a lot of peace of mind in that income guarantee. Let's talk about the accumulation phase. This begins immediately at the time of policy issue and will last a minimum of 30 days. In this phase, the basis for future guaranteed payouts is being built up. If after 30 days you turn on payments to begin receiving lifetime income, this phase ends and the withdrawal phase begins. During the accumulation phase, the rider's premium accumulation value grows. The premium accumulation value is a value that is used to determine the lifetime withdrawal benefit amount. It is not a value that can be surrendered or withdrawn, and the higher the premium accumulation value grows during the rider's accumulation phase, the greater your lifetime income payments will be. The initial premium accumulation value amount is equal to your premium plus an immediately credited benefit-based bonus. The resulting amount accrues interest compounded daily at a competitive guaranteed roll-up rate for 3 years or until the withdrawal phase begins, if earlier. Your benefit-based bonus percentage and roll-up rate are shown on your rider schedule. So when you buy a policy like this, you're going to get what's called a rider's data specification page. On that page in the policy, it will state how the income benefit base rolls up or is credited on a guaranteed basis. It'll also tell us any applicable benefit-based bonuses and how long we can defer this annuity to capture those guaranteed roll-up rates to grow that income benefit value. If you'd like to take a look at the current rates for this particular product offered by Ameritas, you can visit our website at annuityassociation.com and click there to request your free report. The Future Now riders also offer a step-up feature on each policy anniversary during the accumulation phase. Your premium account value or accumulation value will automatically increase or step up to the Apex Advantage accumulation value if larger. So this is a unique feature that not all indexed annuities with guaranteed lifetime income riders offer, and that is the ability to have a step up in income if the index accounts outperform the minimum guarantees of the income rider. So they're saying here, if the accumulation value is larger than the income benefit value, or what they refer to as the premium accumulation value, then they will step up that income guarantee to reflect the larger of the two. So very cool. The withdrawal phase is when you elect to begin receiving guaranteed income payments of your Apex Advantage value. The withdrawal phase of your Future Now income rider begins. To start withdrawals, the policy must have been enforced for at least 30 days, and all selected covered persons must be at least 50 years old. At the beginning of the withdrawal phase, the greater of the policy's accumulation value or the premium accumulation value is used as the benefit base, a value that is multiplied by the lifetime distribution factor to determine your payout amounts. The lifetime distribution factors depend on various factors, including the issue, age, and gender of the youngest covered person, payout option chosen, and whether income is based on a single life or joint spousal option, policy year in which you initiate payments, and whether your annuity is held within a qualified plan subject to the Employee Retirement Income Security Act, or ERISA. For annuities issued within a 401A, 401K, SEP, Simple, or 457B ERISA qualified plan, unisex distribution factors apply. Refer to your policy for lifetime distribution factors applicable to your situation, or ask your insurance professional for a hypothetical illustration specific to your situation. Once you begin receiving income payments, the lifetime distribution factor will not change. So that's a lot of verbiage there, but basically, to sum it up, they're inside the income rider specification page for the policy. You're also purchasing within that income rider what's called the payout schedule. The payout schedule is contractual, and it stipulates how much income will you receive based on your age at the time of income election, the year of deferral that you're in at the time of income election, and whether or not it's single or joint life, or in male and female gender. So if there's a joint life benefit, it's going to defer to the youngest of the two annuitants in this case to determine what the payout percentage will be. But essentially what's going to happen is whenever you get to that year where you're ready to activate the lifetime income stream, you can look at your policy and see that income rider specification page and determine what the payout percentage will be of that premium accumulation value. So if the premium accumulation value, let's say, is 100,000, just for easy numbers, and in the fourth year, if you defer that for those 4 years and you decide to turn on a single or joint life benefit, it's going to state in the contract what the percentage of payout will be for that specified income election option. So it might say, it's 7%. For single, or 7.5 for joint, and whatever it is, and whatever you elect, that's the percentage that they would then multiply against the premium accumulation value or income benefit value. And once they formulate that and do the math there, the end number that you would receive would be after those factors have been calculated. In addition, you can select a number of different payout options. You can select a level payout option. This option provides level payments throughout your life, and it may be a good choice for people on a fixed income who need to plan for payments that will not change. In general, this payout option will have higher distribution factors than the increasing payout option, so payouts will be higher when the withdrawal phase begins. And then in addition, they have the increasing payout option. This option provides income payments that have the opportunity to grow throughout your lifetime. It may be a good choice for people who want to help offset inflation or anticipate increasing expenses. In general, this payout option will have lower distribution factors than the level payout option, so payments will be lower when the withdrawal phase begins. But unlike the level payout option, it offers a 100% interest credit multiplier during the withdrawal phase. This allows your benefit base to increase dollar for dollar by the interest credited to your annuity. Each time the benefit base increases, your lifetime payments will be recalculated to a higher dollar amount. Full transparency, I'd say 95% or more of our clients choose the level payout option. Main reason being is that the level payout option is going to offer you a significantly higher day one income right out of the gate when you decide to turn the income stream on versus the increasing payout option. There's generally going to be a number of years, if you did elect to have the increasing payout option, of how long it would take for that increasing payout option to exceed what the level payout option amount was. We believe that you should be buying annuities based on the highest contractual guarantees and not on hypotheticals. We don't know if the indexes are going to perform or what the markets are going to do to influence those indexes. So rather than taking chance and trying to plan on something that we have no control over, I believe the best bet is to select the highest amount of level payout option that you can secure. And then that's where the rest of your monies and your estates that are outside of the annuity can then, be invested in the markets in some fashion. And if you have growth from the markets, you can take that supplemental growth to then supplement your income, to increase it over time and act as an inflation buffer, if you will. In my opinion, based on our research, that's the most optimal approach to secure the highest foundation of guaranteed lifetime income while also having an inflation hedge over time. Single and joint life options, obviously, very self-explanatory there, so I'm not going to read those verbatim, but you can elect at the time of income election for single life, which just covers one person, or joint spousal option, which covers you and your spouse. Once you've made that election, it cannot be changed. So it's very important that you consider all of the factors there to make a good decision. All right. So the guaranteed phase is what begins when all your funds in your Apex Advantage policy have been paid and your accumulation value has been reduced to zero. During this phase, rider charges will no longer apply and you will continue to receive lifetime payouts. So all they're calling that, it's kind of weird because they're the only ones that kind of refer to this, but they're calling this the guaranteed phase, which they're saying if or when the accumulation value is depleted to zero after turning on income and it's starting to erode that account value each year. Once it is reduced to zero, they're referring to the period of time after that as the guaranteed phase. And that is when the income still continues to pay out, even though there's no more money left in the account. In addition, they no longer charge any rider fees to the policy at that point. The rider charge is assessed monthly against the policy accumulation value. The rider charge is equal to the annual rider charge, which is shown below, divided by 12 times the rider charge base. During the accumulation phase, the rider charge base is equal to the premium accumulation value at the time the rider charge is assessed. And during the withdrawal phase, the rider charge base is equal to the benefit base at the time the rider charge is assessed. Again, the Future Now rider is at 1.25% with the Future Now rider with booster at 1.35%. The rider charge rate may change after the first 10 policy years, but will never be greater than the maximum rate shown on your policy. If the policy's accumulation value reaches zero, again, rider charges will no longer apply. Should your circumstances change and you no longer need ongoing income, you may terminate the rider after the policy's 5th anniversary. Once the rider is terminated, rider charges cease and the rider may not be reinstated. And last but not least is the death benefit. To help leave a legacy for your loved ones, Apex Advantage by Ameritas offers a reliable death benefit. Death benefit proceeds will be paid directly to your chosen beneficiaries and are generally free from the hassles, publicity, and delays of probate. One of the biggest misconceptions in annuities is that people sometimes say that or think that in the event you buy an annuity and you die, the insurance company keeps your money. In about 99% of the scenarios out there, that is not the case. Whatever's left in the account value at the time of death will pass on to the designated beneficiaries in the contract. There's only one type of annuity out there structured in one particular way that if you did pass away, then whatever's left or whatever income was being paid out, that's gone and there's no value that can be passed on through a death benefit. But very rare that anybody purchases that type of annuity today, since there are these types of options available that can help you address primary objectives of lifetime income, followed by secondary objectives of having a chance to leave whatever's left to a loved one or charity of choice. If you die prior to the policy's maturity date, which is the date on which annuity payments will begin, When they're referring to annuity payments, they're talking about annuitization payments, not lifetime income rider payments. So that's something that you need to be aware of when you're reading this. If you're not familiar with the terminology, you could get confused. When you activate the lifetime income rider, you're not giving up control over the account value, and that account value is the death benefit. If you annuitize, you give up control over the principal account, which is also the death benefit account. So what they're saying here is the date on which annuity payments will begin. The keyword's annuity, okay, which they're referring to annuitization payments. That's not income rider payments. That's if you annuitize, okay? The death benefit is the greater of your accumulation value or the minimum guaranteed surrender value. Your beneficiary has the option to receive the death benefit anytime within 5 years of your date of death and may choose to receive a lump sum payment or select one of the available annuitization options. If the beneficiary is your spouse, he or she may choose to continue the policy as the owner. If you die after annuitization payments have begun, the remaining amount of the annuity benefit, if any, will continue to be paid to your beneficiary under your selected annuitization option. And a little bit about Ameritas Life Insurance Corporation. They were founded in 1887. Ameritas Life Insurance Corporation and its affiliated companies provide a wide range of insurance and financial products and services to individuals, families, and businesses throughout the United States. Offering a strong balance sheet, Ameritas has an established, proven foundation of stability that you can trust. Its long-standing financial health provides the strength and security that customers expect, reflected in consistently strong ratings earned from independent ratings agencies. So through AM Best, they hold a financial stability rating of A, which is excellent for insurer financial strength. This is the third highest of AM Best 13 ratings. And then through Standard & Poor's, they hold an A+, which is considered strong for insurer financial strength. This is the fifth highest of Standard & Poor's 21 ratings. And then, of course, for more information about Apex Advantage or to discuss whether it may be right for you, I personally would invite you to visit our website at annuityassociation.com. And right there on that page, you can do one of two things. You can request your free report to see how this annuity may stack up against the rest for your given circumstances. Or if you think that you've learned enough to really want to compare this annuity across the others and do so in a very transparent and educational fashion, you can schedule your first annuity discovery meeting with our firm, and we will take you through that comparative process to help you make a better annuity buying decision. We work with clients in all 50 states, and we are A+ accredited on the Better Business Bureau. So if you'd like to speak with us, we would love that opportunity to see how we can help point you in the right direction. Again, go to annuityassociation.com and we will see how we can help. Okay, so let me stop my screen share here, and we are going to get into the index crediting option analysis momentarily. Hope everybody's having a happy Friday out there. All righty, let's go ahead and share my screen again here. Using this cool software that streams on multiple outlets. Right now we're live on Facebook. We're supposed to be live on LinkedIn, but looks like that connection's not working for some reason. And then we're also on YouTube. Okay, let's share my screen. Hopefully it works. Here we go. All righty, so hopefully you can see this okay. If you need to make it a little larger, let's see if I can, here we go, I can do that for you. So what we're looking at now is our handy dandy software that helps us analyze the various index crediting options in each of these types of annuities to help us get a better understanding of what the growth potential could possibly be if markets and index performance were to behave in a similar fashion using these hypothetical periods of time, which is the last 10 and 15 years if the data still is available. Sometimes these indexes that are offered, the asset classes that comprise these indexes, haven't been around that long. So, if they've only been around for 10 years, then obviously we can only get the data for that period of time. But anyhow, we're looking at the Ameritas Life Insurance Corporation fixed indexed annuity that they refer to as the Apex Advantage. And this is showing us the 5 different crediting options available for the index crediting strategies. And then what it's doing is ranking them based on the hypothetical back-tested performance using the last 10 calendar years. It's ranking them chronologically highest to lowest based on that backtest. So over to the right, you're going to see the average annualized return using the last 10 calendar years of data from December 31st of 2013 to December 31st of 2023. And then over to the left, you're going to see the specific index crediting strategy, including the crediting term and the crediting type. So the crediting term in this case on this first example is the 2-year BNP U.S. Governance Multi-Asset Index. BNP U.S. Governance Multi-Asset Index. These are live indexes that can easily be tracked. If you were to take this and just simply go to Google, you could find the live page right here. And this would give you the raw performance of that index so that you can view it with your own eyes, right from the horse's mouth, which in this case is BNP Paribas. It tells you all about how the index is comprised, what the volatility controls are, and how it's governed. In addition, you can find the raw performance to get a better understanding of how it's performed over time. And then what our software is designed to do is take those raw performance figures, back tested over the last 10 and 15 years, and then apply the crediting terms, which in this case for the Ameritas Apex Advantage Indexed Annuity, it's a point-to-point strategy using a participation rate. In this case, it's a 235% participation. So basically, it's a simple formula. It's the raw performance of that index, in this case, the BNP U.S. Governance Multi-Asset Index, over a 2-year crediting term. So that point-to-point terminology, what they're referencing there is the starting point to the ending point. In this case, the starting point would be the issue date of the annuity policy. So let's say it was today, September 20th of 24. And then they're going to monitor that index's performance from that starting point or that date to the ending point, which would be the 2-year anniversary of that policy, which would be September 20th of 2026. And whatever the raw performance was for that 2-year period of time, let's say it's 10%, they're going to take that 10% raw performance figure and multiply it against the participation rate. So in this case, it's 235%. So if your index raw performance was 10% and you've got a 235% participation, which is essentially a multiplier, the interest credit that would be credited to your accumulation value would be 23.5%. So very simple math. A lot of people get hung up in, the participation rates, and they automatically assume that, the highest participation rates are always better. That's not true at all. That's just one factor of the formula. If you have a index that literally does nothing, let's say it earns 0 for that 2 years, but you got a 500% participation rate, well, 500% of 0 is still 0. So it's not just finding high participation rates. It's about finding a good combination of the two. Good, strong, raw performance and high participation rate. And if you can find the best blend of those two, you're going to find a good opportunity for growth. Anyhow, once they're factoring in the participation and raw performance over the last 10 years, based on that hypothetical backtest, this crediting strategy would have performed at 10.3% a year assuming you owned it during this time frame. Now you might see these two figures above, one above and one below that 10.3%. The green figure, the 16.66%, is the best consecutive 10-year period over the last 20 years. And that's the annualized return. So they're analyzing the last 20 years of data and saying, what would the best 10 consecutive year period have been? Well, what would that return have looked like? And in this case, it's 16.66%. Conversely, they're also identifying the worst consecutive 10 years out of the last 20. This is still a positive return. It's just red indicating the worst consecutive 10, and it's 10.3%. Next, we have the 1-year BNP U.S. Governance Multi-Asset Index, again, point to point with a participation rate. And this is a 1-year crediting term. That's the only difference. For a lesser crediting term, you're also going to often find a lesser participation rate. In this case, it drops from 235 to 170. And then we'll see how that impacts the annualized return using the same 10 calendar years and the hypothetical backtest. Next is the S&P Mark V ER index. It's a 2-year point-to-point with a participation, 205% participation, and we'll see a lower return at 7.15% using the last 10 years in this hypothetical backtest. So what does this mean? Well, it's obviously got a little bit lower of a participation, but obviously that's not just the only indicator here that's relevant to this equation. Obviously, the S&P Mark V over that same 10 years performed lower raw performance-wise than the BNP U.S. Governance Multi-Asset Index. So when you have a lower raw performance and a lower participation, that's going to influence the average annualized return. Rounding out the last two, the 1-year S&P Mark V at 150% par, and then they also offer a 1-year S&P 500 with a participation rate of 43%. Not a bad option, honestly, if you like the S&P 500, or maybe you just want to keep it plain Jane and not have any of these other, hybrid type indexes that are maybe a little bit more difficult to follow and track. This is the pure S&P 500. It's a point-to-point 1-year strategy with a participation rate of 43%. So whatever the S&P does, you would earn 43% of it. So I believe last year the S&P was up 17.77%. Multiply that by the 43 participation, and you would have got 7.64% credited to your account value. Very cool. All right, last but not least, I am going to get dialed up our software to take a look at the income rider, and then we will conclude this review. So I appreciate you tuning in. If you'd like to work with our firm directly, you're getting some value out of this, you'd like a way to truly compare all of the options on the independent annuity marketplace for safe growth and lifetime income, we'd love the opportunity to work with you. We pride ourselves in providing transparency and education, ultimately to deliver our mission, and that is to help people make better annuity buying decisions. We believe that annuities shouldn't be sold, but rather they should be bought, because you've increased your annuity IQ to a higher level to make your own informed decision. And that is something that we're very passionate about. So if you'd like the opportunity to work with us, we'd love the opportunity to work with you. You can visit our website at annuityassociation.com. Right there on the main page, you can click the button there to schedule your free, no hassle, no obligation, no pressure annuity discovery meeting, and we can see how we can help point you in the right direction. All righty. Let me go ahead and share my screen here, and we'll get into the income rider presentation. All right. So here what we're looking at is our software that we use to analyze the entire lifetime income annuity marketplace to help us as advisors, but more so to help you find and identify the highest paying guaranteed lifetime income annuity for your particular situation. So what we have the ability to do here is input your state, your age, your premium investment amount, and whether it's single or joint life income. And then we indicate how many years you anticipate deferring the income stream before you decide to turn it on. Right now, I have this filtered for just the Ameritas Apex Advantage. And so we're going to see how it works. So right now we have $100,000 for a 60-year-old male. Let's go ahead and do joint real fast. And he's married to let's do 58-year-old spouse. And they're planning to defer income for 7 years, turning it on at age 67. So I guess that'd be 6 full years of deferral, turning on income in contract year 7. So what we're going to do for a quick exercise is we're going to see how this income benefit grows guaranteed each year of deferral. Before we do that, over on the far right of my screen, you're going to see a box. And in this box or rectangle over here, it's going to show us the guaranteed parameters of the lifetime income rider contract at the time of this recording, which is September 20th of 2024. We are in a declining interest rate environment. So chances are, if you're watching this review at a later point in time, the rates could be lower than what you see today. And they could also be higher. We don't know what the interest rate environment holds, but from what we understand it, we are trending downward, and that will impact annuity rates. So this product right now has a 51% income base bonus. So what that means is day one, money going into the policy is going to be credited a 51% bonus towards the income benefit value. The income benefit value is not withdrawable as a lump sum. So don't get all excited thinking you're going to, be able to cash this money out right after you put it in and grow it by 51%. That doesn't happen. That's not an option. What that income benefit value is used for is to calculate the lifetime payment for you and your spouse. So again, 51% bonus. And then each year that we defer this income, it's going to guarantee a 6% roll-up interest rate that's applied and credited to the income benefit value as well. Because this has a 3-year roll-up, I guess it'd be best to exercise that for 3 years. So deferring it for 3 full years. And so let's start with year 1. So when we defer 1 year contractually, the income benefit value is going to grow by 6%. So you see it went from 151. Let me go back. So here's the income benefit value. And here is the lifetime payout percentage based on the age of at the time of income election and whether or not it's single or joint life. So watch what happens. So this got the one-time bonus. If you were activating it immediately, there would be no roll-up of 6%. But if you're going to defer it, watch what happens to that 151. It now grew guaranteed to 160,060. And then another observation is that the payout percentage went up as well because the person aged another year. The younger of the two annuitants advanced in age after that 1 year of deferral. We go out a second year. Now the $160,000 income benefit went to 169.6, and that's because it got another 6% credited to the income benefit value. And then that payout percentage also went up by just over 10 basis points to 4.1%, again because the youngest of the two annuitants advanced in age. And then last but not least, we defer it another year, so 3 years total. We'll now see the income benefit value based on 100,000 has grown guaranteed to 179,843, and the payout percentage also increased to 4.2%. We see the rider cost over here at 1.25%, and then just below this we have the rider, the future now rider level with booster showing us the 1.35% rider cost. And why that increase in rider cost is because it has that enhanced income benefit rider for long-term care, confined care, or home health care. So how that works is, in the event you had a need for long-term care or confined care of some sort, and there was still account value left, you could elect to have that enhanced income benefit paid out, which would double the amount of guaranteed lifetime income. And it would pay that doubled amount for up to 5 years to help you cover those additional costs of care. So very cool there. I believe it's worth it for the extra 10 basis points, but totally up to you. It's a great addition to a retirement plan, especially if you don't have any plans in place for long-term care. So this about rounds out our review today for the Ameritas Apex Advantage Fixed Indexed Annuity. If you'd like to dive into this product more, to learn more about it, or if you'd like to compare this product against all the others out there, the hundreds of other products in this marketplace, we'd be happy to take you through that educational and transparent process. We'll get an understanding of what's important to you, what matters most, and what you want your outcomes to be. And then we will right fit an annuity that will help you serve those objectives and deliver the outcomes you desire. To do that, you can go to our website at annuityassociation.com. Right there on the main page, you can click to request your free report. Or if you wanted to schedule a meeting directly, you can also click a button on that main page to request your annuity discovery meeting. It'll take you to our calendar, pop you on to one of our team of advisors' calendar to help connect with you via Zoom and see how we can help. We take clients through a very educational and transparent process of comparison, help you side by side compare all of the products available on the market for income, and help you make a better annuity buying decision. Again, we serve clients in all 50 states. We'd love the opportunity to connect with you on Zoom to see how we can help. This is Jeremiah Conger with Annuity Association signing off. We appreciate you watching. And if you've gotten some value, we'd really hope that you'd share this with a friend or family member across your social platforms to help get the word out there that we're doing these types of reviews. It'll help us deliver on our mission of helping people make better annuity buying decisions. And we certainly appreciate the support. Thanks so much for watching. Have a great day. Have a great weekend, and take care of one another. Bye-bye.